all the strategies that you think are unique, really novel and bleeding edge has already been picked out and is already dead. Sorry, that's just the reality of it. And so you have to really start to think beyond the basics, right? And really go deeper.
My guest this week is Christina Qi. In 2015, she gained notoriety for founding a high-frequency trading shop as a college student. While taking classes at MIT, her firm, Domeyard, was competing with the likes of Citadel and Millennium.
In my mind, if a college student is talking to me saying, hey, I'm raising money for a quantitative hedge fund, I'm skeptical automatically. What was that like?
At first, we thought if we said, oh, we're smart MIT founders, that it would work. Turns out it didn't, because everyone from our school is a smart MIT founder. The HFT angle really worked well for us because at the time, there really wasn't a lot of new HFT funds launching. The year that we had the most investors redeeming, as in pulling out of our fund, was a year that we were doing pretty well. And that the year that we did poorly, which was 2020, all of the investors were like, oh, you got this. And they were like, no, we want to stay in the fund. And we were like, no, we're going to shut down.
Domeyard closed down in 2022, and she later founded Databento, the first data vendor offering easy-to-use, on-demand market data with transparent pricing.
When we had market data from all these other providers back in the day, we were restricted by what we could do with the data. We're like, okay, let's go out there, build a product that's made by quants, make it available to everyone. We want to start a business that could really change the industry and turn it on its feet, basically, and really make it so that a company like Bloomberg will want to catch up to us. Out of all the podcasts I've been on, this is probably one of the best podcasts.
Christina, thank you so much for doing this. You started a hedge fund in your dorm room. What was that like?
It was very surreal. Actually, no, at the time, honestly, I was one of those people where I didn't know what I wanted to do in college. I was not one of those entrepreneurial people, like a lot of kids are like, oh, since I'm a kid, I wanted to be an entrepreneur. That was definitely not me. I did not get an offer after my internship my junior year. And so I was desperately applying to jobs and did not get any offers. And so someone was like, why don't you just trade the trading strategy you did over the summer for your internship? And I was like, okay, I'll just do it. So I started trading the strategy, and it just kind of evolved and turned into I was like, I just might as well trade it and continue trading it. And then eventually I was like, okay, might as well just continue doing this. And, worked with some people on this and found two awesome, really smart people. One who went to my school and then one who went to a school down the street and started it. The name was called Domeyard, which is MIT Dome and Harvard Yard. And so those are just where my co-founders came from and myself. And so we just kind of started from there. And it actually, at the time, I remember we did go through a, what do you call the honeymoon phase, almost like when you're in a relationship and you go through that. We did go through a honeymoon phase at the very beginning. I do remember that. And it did feel really fun. We would spend every waking moment kind of working on it. And that was really fun. We were willing to make a lot of sacrifices, and we ate a very cheap ramen diet at the time. Yeah, and definitely made a lot of really big sacrifices to be able to work on it for sure. Today, would I do that? Absolutely not. But back then, I remember, we were just super excited to be able to work on something, and, just to be able to do a startup, I guess, was really cool. So, yeah.
For sure. It sounds like an extremely exciting thing to do. And I'm sure that a lot of the people that followed you, because I remember the first time I heard about you, I was in high school. So I remember, I think it was my dad, but he sent an article to our family group chat. And it was about these MIT people starting a fund. I mean, who started a fund back in high school. I was like, and I remember you were also just getting started with Databento back then. And I remember being like, wow. And I was maybe I think I was a junior in high school. I was like, whoa, you truly can do big things even at a young age and not knowing that many people. And I found that very inspirational. I'd like to hear a little bit about what it was like starting a hedge fund back then. And obviously you having been in this space for quite some time. What are the differences between starting a fund back then and starting a fund today?
Yeah. First off, thank you. I First off, I live in Utah, in the middle of nowhere. And just, I don't know the impact I have, and just hearing that from you, a high school kid, right, somewhere far away from me, and hearing that your family sent that in a group chat, like that makes me really, really happy to hear that. So first off, thank you. That's really cool, and really means a lot. And so, I think, yeah, for me, the question, just to answer your question about like, what it's like to, I guess, do something new. And then, looking hindsight back, right? What would I do kind of differently as a second time versus first time founder? I would say like, there's a lot of things. I guess when you're a second time founder, the biggest difference is that you have a playbook on a lot of different things. So, for example, I know which lawyer to use. I know which accountant to use. I know which CRM to use, like for, sales and marketing. I know which HR tools to use, which accounting tools to use. So I already kind of have a playbook laid out in front of me, almost like an accelerator playbook that a lot of first-time founders, you need to kind of go out there and figure that out for yourself and take that time to really, call around your local network and figure out, which, especially for legal counsel, you might need a local lawyer, to kind of help you out, especially based on which state you're located in, for example, or which jurisdiction. And for those kinds of things, like there isn't really one firm that's good for everyone. It's not one size fits all. Same with like local accountants and bookkeepers. It's not like one size fits all. So you have to really look around for those. And if you're a second time founder, you already have that playbook. So I think definitely starting my second company, Databento, thankfully we already had that playbook. So it definitely felt a lot more streamlined going in the second time around. But in terms of like actual lessons learned, definitely I could go on for like, I could teach an entire class for like a semester on like, things we did wrong, I guess, the first time around, and then did right, I guess, or at least did better hopefully the second time around. So, in areas like, let's say hiring, HR related, like ongoing HR related things, what it means to even like be a good manager, what it means to hire, how to find the right talent even, even questions like remote versus hybrid versus in person, and, what kind of playbook you should have on that for what industry you're in, at what stage, what size, right? Even questions like that are very interesting challenges, and knowing the answers to those, or at least where to go and have a direction on that, is really, really important. Questions on like how to do sales or how to do marketing, how to build a product, right? I'm trying to think of what else. Sales, marketing, hiring, fundraising, of course, that's a huge skill set. Like that's surprisingly, easier said than done. And there's so many different tools you need to be able to learn how to use. There's so many things that investors expect that if you don't follow that playbook, investors will think you're weird, so there's a lot of little details and things like that. I think that we learned a lot the first time around, and thankfully as a second time founder, it became a lot more, I guess, fluent and easier at the second time around. So yeah, I wish I could elaborate on all of those, but definitely if there's any specific things that people want to hear, I'm more than happy to elaborate.
No, for sure. And I mean, you've mentioned a couple things. I guess the most interesting thing that you've mentioned to me is fundraising, because having, just been out of college, being very, very young, trying to start your own fund. I guess in my mind, if a college student or a recent graduate is talking to me saying, hey, I'm raising money for a quantitative hedge fund, I'm skeptical automatically, right? What was that like? That sounds like something that was extremely challenging to do, especially, not having all this pedigree and all these different connections in the industry to raise millions and millions of dollars.
Yeah, absolutely. That was a huge lesson for us at the very beginning. At first, we thought if we said like, "Oh, we're smart MIT founders," that it would work. Turns out it didn't, because everyone from our school is a smart MIT founder. There's like 30,000 of us, and we're all smart MIT founders, and it just really didn't work. So then we had to really change our fundraising strategy and look at, what really worked for us. Surprisingly, was at the time, so we're building high frequency trading strategies, and the HFT angle really worked well for us, because at the time there really wasn't a lot of new kind of HFT funds launching. This was actually pre Flash Boys, like the book Flash Boys hadn't been published yet, and so we were actually doing something that was fairly, I guess the public hadn't really heard about that wasn't even a term yet in this space. And so yeah, it was actually fairly, I don't want to say novel, but at least it was not quite in the public eye at that time. And so, when we did pitch that to investors and we pitched like the types of strategies that we were running, it did appeal to a lot of, especially allocators. There were specific allocators that invested in day one. They're basically like they're meant to invest in day one managers, I guess, like hedge fund launches essentially. And what they expect of us is, yes, they would want lower fees. They would want higher control. So they would want like a lower lockup period. They definitely would want certain types of, like easier redemption, right? So they could redeem at any point in time, lower fees, etc. Right? As a reward for taking that huge risk of being your day one investor, essentially. And if you think about it, this is one thing I tell a lot of people who are launching, if they're trying to launch a hedge fund, is like your goal for launching your hedge fund on day one is not to like, I don't know, make $1 billion or whatever, right? Like your goal is to establish a track record, right? Your goal is to literally like get your track record, get up and running, so that you can raise your day two money, right? You really need to get that track record first and foremost. And so that was for us, that's how we thought about it, was like we really needed that track record. And so we had those day one investors onboarded. We basically just gave them, pretty generous fees. And we were like, here you go, right? For us, the goal was like, let's just get our track record going first. And we went from there. So yeah, thankfully we were able to go from there. Oh, we did. The other thing I should mention though, we also did raise a little bit of venture capital at the very beginning as well. And how we were able to pull that off, we were not alone in doing this, by the way. There was us and there was another firm across the street from us called Quantopian. Both of us were able to raise venture capital. And the reason why we pulled it off was because we both had technology behind the scenes. So a lot of hedge funds, you just kind of like have strategies and you just kind of, I don't know, use a Bloomberg terminal, right? But if you're building technology behind the scenes, so, Quantopian had their own backtesting platform and they had like a lot of unique kind of IP that they built. Same with us. So we had our own IP. We built our own order management system, our own data feed handlers, our market engine simulators. Like we had a lot of tools behind the scenes that were all kind of our own. And so as a result of that, we could raise venture capital because we had IP behind the scenes as well that we're building. So yeah. So anyway, all that being said, yeah, it's difficult. Would I be able to go out there and raise today? The answer is probably no, actually. I don't think in this day and age, because a lot of those tools have been democratized to begin with as well. An investor would be like, why would you need to reinvent the wheel, right? You can literally go out there. There's tons of, backtesting tools out there that are, plenty enough for what we're trying to achieve anyway. And so, we could just get to launch a lot quicker with what's out there already. And, we wouldn't even need to spend the time to build those things. So, yeah.
Fascinating. Sounds extremely challenging. You think you touched a little bit on it earlier, but I mean, towards the end of what you were saying, would you say it's much harder to do all this today, or was it easier back then? Because I guess on one side of the coin, there's there's so many backtesting platforms, education around quant finance is extremely prevalent. I go on X, there's Giuseppe Paliogo, there's so many different anonymous accounts who give away, free, high quality, high signal, really insightful tools. There's great books on the subject. There's a lot of discourse. And so on one end, it's easier to learn these things, but on the other end, as you were saying, it's extremely saturated. I imagine it was easier to find edge back then than it is today. I'd love to hear your thoughts on that.
Oh, absolutely. Yeah. I guess the way to put it is that the barrier to entry has lowered a lot in this industry, right? It's easier than ever to access tools. Even for like coding, right? Like you can literally just use AI and just vibe code your way into doing a quant strategy or into building an app on your phone, or right, you could literally just vibe code your way into doing anything these days. So same with like accessing data in this industry, like 10 plus years ago, is like getting access to high quality order book data was really, really difficult to do unless you were like a large institution. You had the money and had the connections to do so. Whereas today, it's like you can literally just go on your laptop in your bedroom and just like access data. And I'm not going to pitch our company. I'm saying for not just from us, from like, dozen other companies out there, right? So just saying that it's a lot easier today to access not just data, but any kind of tools you need, back testers and, other kind of quant trading strategies and books, right? There's a lot of books, literature, trading gurus on, for better or worse, right? Some of them are whack and some of them are not. But at least they do exist. And there's this whole FinTwit community out there. And they're, some are good, some are not. And so yeah, like there's Discord communities and Twitter and like LinkedIn and stuff, and everyone's talking. And so as a result of that, the barrier to entry has lowered. And as a result of that, also the alpha, the edge, of course, it's going to be harder. All the lower hanging fruit has all been kind of picked out. And so now you got to like kind of aim for like the higher hanging fruit and try to find like the more difficult opportunities that are out there, and figure out, okay, what is there? What kind of alpha can I find that everyone else has not thought about? So like all the strategies that you think are unique, that I don't know, that you would think are, really novel and bleeding edge, has already been picked out and like is already dead. Sorry. That's just kind of the reality of it. And so you have to really start to think beyond, the basics, right? And really go deeper. So yeah, that's kind of the reality of it today.
100%. And what you said about it's really easy. I mean, the barrier to entry is a lot lower, like 100% true. In fact, I'll share a story. I think this was like a year ago or two. I think this was 2 years ago. I was in the library of my, I was in the library of my dorm. And one of my friends goes, like, because he knew I was really interested in quant trading. And you were talking and he was telling me, dude, I have this friend. His strategy's been making 30% a month. And I'm like, I hear that and I'm like, that's absolutely unheard of. How is that even possible? Right? Dude, I think I'm going to give him, he said he's going to give him like 500 pounds for him to, just have some extra income on the side. I was like, I'm obviously super skeptical. There's like, maybe he's like 100x leverage or whatever. And then like he comes back to me a week later and he starts laughing because he tells me, dude, they lost like 80% in a day. I was like, okay, yeah, I mean, makes sense. Like, I was like, but like, you just, and I think that's a prime example of the fact that the barrier to entry is so low. Some college students just, using some data, some API or whatever, using it, like I don't know, one of these platforms and trading their own money. I guess I want to talk a bit more about what you're doing now. So you started Databento, and first off, I'm just curious why. And second of all, like, what are the lessons you took from being in this being the second company you're building? I'd love to hear about, the two sides, the lessons and also why you're building.
Yeah, for sure. So I guess like, wow, there's a lot for sure. So first off, Domeyard died around the time of the pandemic. We had a bad year around 2020. Oh, this is actually an interesting lesson, by the way. And I actually just talked about this yesterday I had an office hour session, which is basically like just a community thing I like to do where we just kind of go on Zoom with a bunch of people kind of in the community. Most of them are usually launching a startup or hedge fund. And we just kind of talk, and usually I answer questions on stuff. And one of the things that I talk about a lot is actually there's a difference between for us at least, between performance and investors like redeeming out of the fund. And I was telling them how actually the year that we had the most investors redeeming, like as in pulling out of our fund, was a year that we were doing pretty well. And that the year that we did poorly, which was the pandemic 2020, all of the investors were like, oh, you got this. And they were like, no, we want to like stay in the fund. And we were like, no, we're going to shut down. And so just saying that, it's never the years that you expect, and it's never kind of, there's a difference between, performance and investors like, coming in and out of your fund. Like, and so investor relations is like a different beast in and of itself. And having someone in your fund, if you do manage a fund, like having someone who's good at investor relations is like really, really important, because their job is to keep the investors in the fund. And sometimes they'll like pull out on a good year, and you just literally never know. You can keep them in on a bad year, and that's like really awesome. So anyway, that all being said, is we did decide to shut down, mainly because actually the strategy is not scalable. We weren't down 80%. We were down, it was down 12%. Like, it's not bad, but we're like, now the HFT business is not scalable. We've been at it for a while. But HFT is just not scalable in general, by the way. And so we're like, and data's been plaguing us for a while. We've always had this data problem. So anyway, that'll be, long story short, is like we started Databento, really wanted to solve kind of this issue we had where, how do you describe this? Like, when we had like market data from all these other providers back in the day, we were restricted by what we could do with the data, I guess is the best way to put it. Like, we weren't allowed, we got like all these legal letters from, all these different data, like everyone's worked with it. And they're like, oh, you basically cannot build XYZ on top of our data. That's considered like theft, and all these licensing restrictions and stuff. That was really annoying for us. And then on top of that, so the data licensing was really obnoxious. There were the API, like the way that the APIs are built, the data quality is terrible. The data timestamping is not harmonized. The data is like usually built around a terminal first, and then like the API products like the afterthought. I don't know. There's a lot of really awful, like just backwards data providers that were not really designed around an API era. And so we were like, and then also the startups were kind of like retail kind of based. And so we're like, you know what, let's just be like a quant data provider that's meant to be like more institutional. So, so we're like, okay, let's go out there, design, build a product that's like made by quants, for like, for institutions, but of course, like make it available to everyone, make like lower the barrier to entry for everyone. Make the entry point very like cheap, very accessible as much as possible. We can't be a charity, obviously, like, it can't be free, but at least like make it as affordable as it can possibly be, without compromising on quality. Right. And so, that's what we do in a nutshell. We're market data API product. And then, we launched about 2 years ago, 16,000 plus customers and growing. We get about anywhere from 50 to 75 new, like actual individual customers, not users, like actual individual customers with their own credit cards, like individually per day. So that's pretty cool. And then, lots of institutions. So like, I think all of the like, I'd say 8 out of the 10, maybe almost all of them, the largest like options market makers, for example, use Databento today in the world today. So lots of great companies. I don't know if I'm allowed to. Most of the names I'm not even allowed to say, because they'll like come and sue me, or not sue me. They'll like send me a very like angry letter if I mention any names, unfortunately. But there's a lot of great firms that use us behind the scenes, which is really fun. And then, you asked about like, I know the challenges and kind of what it was like and stuff as a second time, or I guess hindsight hindsight is like 2020 or whatever. So I would say like main difference in kind of what it was like. I would say the biggest things on my end would be just lessons taken. How do I describe this? Definitely knowing better on how to scale. We wanted to have a business that was scalable. That was the first thing. Our first company was not scalable. And so this time we're like, okay, we want a business that is scalable, that has an exit opportunity beyond, just how big we could grow the hedge fund. And so that was really important to us. I think the second thing is we wanted to start a business that was not just like a cheaper Bloomberg or something, right? Like, that's not really how you want to operate. That's not innovative, right? We want to start a business that could really change the industry and turn it on its feet, basically, and innovate, and really make it so that a company like Bloomberg would want to catch up to us, essentially. And so that's really what we've done. And it's gone to the point where the incumbents are really starting to actually come after us in a crazy way. We've had companies plagiarize us. We've had like all kinds of crazy incidents now as a result. So that's really cool. I think that is actually like a really big compliment that companies are starting to come after us us. They're starting to plagiarize us. They're starting to really like try to emulate everything we're doing because we're starting to set the stage and really move things forward and push things into like how things really should be in this industry. So yeah, that's kind of those are the biggest things we've learned.
Oh, imitation is the greatest form of flattery. So I mean, if these guys are plagiarizing you and coming after you, it shows you doing something right. I was gonna ask like more general questions, but I guess the thing I am now very curious about is what is it like taking on, and I guess this is still general, but it's more about, I guess, your outlook. Because I don't know if I've heard you talk about this on a podcast or in an interview prior, but what is it like being, disrupting incumbents in the space when you're severely undercapitalized compared to them. You don't have the size team they have. It seems like there'd be a lot of headwinds, in your position, and I'm sure there are. I'm sure you're dealing with it well, but what is it like?
Yeah, for sure. And that is a fantastic question. We have 1/1000th their budget, probably. We have 1/1000th their team, probably. And so right? Like, how do we survive even? And how do we get to this many customers? And how do we even get the largest firms in the industry to notice us and come over and convert to us? How did we get, unfortunately, I can't say these names, but the biggest names in not only finance, but also we have the biggest names in AI using Databento, and they chose us over the incumbent providers deliberately. And so how do we get those names? I guess, how do we operate like this? We adopted very early on a PLG mechanism, which is PLG stands for product-led growth. And basically we noticed this early on, which is that we're selling to quants, basically. We're selling to data scientists, quants, traders, developers. These are some of the smartest people in the world, not just in the industry. These are the smartest people in the world, right? And the challenge is that actually I'm not trying to sell to Ray Dalio, right? I'm selling to his analyst on the team. I'm selling to his trader. I'm selling to the bottom of their company. I'm not selling to the top, right? And so the challenge I realize is like the incumbents, they sell top down actually, whereas Databento sells bottom up. And so that is how we disrupt. That is how we do it at 1/1000th of their budget, is that our whole entire product, our website is designed, and like literally we design it to appeal to someone at the very bottom. And so like if you have a use case where you need to just, literally just download some stock or some piece of data, you can literally just go on our website immediately, add to cart, check out, get the data instantly onto your laptop, onto your computer, your workstation instantly, get your boss's approval later, right? But it's like just an instant process. And I think that's why it's extremely appealing, because you can go past and bypass that approval process a little bit. And then of course, like, get your boss's approval, whatever, upgrade over, get your boss's signature or whatever you need to do, right? But it's a bottom up process eventually. But versus top down, look, you go on a competitor's website, our incumbents, you have to fill out a form, talk to sales. They'll send you 60 questions, like, what's your legal structure? Imagine if you work at Bank of America and it's like, what's your legal structure? Like, I don't know the legal structure of Bank of America. I don't know how many people work at Bank of America, right? They're going to ask you like how many people work at your company and stuff. And you don't know those answers because they sell top down. And so again, like that's why our business model is extremely appealing, because we design the product to be self-service. The product is literally on the website. We're not gate kept behind salespeople. Now the incumbents, they can't decimate their, they have thousands of salespeople, right? They can't decimate their thousands of salespeople to copy our business model, because their whole product is gate kept behind, all these salespeople essentially. So that's essentially why, we can operate at 1/1000th of their budget. So, yeah, that's basically how we do it in a nutshell.
Wow. What you said there about selling bottom up versus top down, that's not something I've heard before, and I think that's super insightful. It reminds me of like this thing my dad would say when he was like selling for his business. He'd always talk like people on the bottom, the people you're actually dealing with, and I think about it now like, wow, no, 100%.
Yeah.
Um,
I have a quick
yeah,
story actually, if that's okay.
please.
So I'll tell you, I can't name the name, but I'll just say like the biggest AI company in the world approached Databento, and I've never, we've never interacted with them before previously, right? And the first email they sent us was, "Hey, we want to buy your most expensive data plan," and we were like, "What?" And the email, it wasn't like, "Hey, we're comparing you versus another data company. Can you, tell us your pros and cons?" It was like literally, "Hey, we've already decided to use you. Please send us your payment instructions, ASAP." And we were like, "What?" They had already decided to use us because our entire product, all of our pricing, everything is on our website, transparently laid out. And then we looked at who reached out to us, what was their name and title, and it wasn't the famous guy you see in the news all the time, not the CEO or whoever. It was literally their title is member of the technical staff. And we were like, holy crap, like, this person's probably like 25 years old, right? And then we realized like these members of the technical staff have a lot of buying power. They really do. And a lot of these incumbents underestimate the buying power that these people at the bottom, have within these large companies essentially. So I did want to mention that as kind of a huge lesson learned that these like, software engineers, technical people have a ton of power in terms of buying decisions on, what products they want to buy, what data they want to buy, et cetera. So yeah.
Fascinating. Can I ask what data set that was?
I unfortunately can't mention it because it's a part of their
No
a part
worries.
of their like strategy.
Yeah.
But I'll say that when you ask a question now on their on their platform or whatever, that data comes from us behind the scenes. So yeah,
Wow.
they're training on our data to, answer. Right now, look, actually, what's interesting is that there currently isn't really a winner in data AI for finance, right? Like if you ask someone some kind of question related to the stock market, trends in the market, stuff like that, there really isn't a current, really clear winner on AI in finance. And so I think right now there's an arms race. We do notice that, like a lot of people, trying to build the next big thing in that space. And it's really cool. We don't know who's going to win yet, but, we're definitely, rooting for everyone, I guess. Yeah.
It's super exciting. And actually, there is something I'm curious about because the person that pops to my head when thinking about Bloomberg, and I guess because that's the incumbent in this space, I guess, if you were to come up with one. And for years and years and years, everyone, and I remember even back, I was in high school looking at the YC companies, and one of them was trying to build like a Bloomberg for retail traders. And I feel like I've heard that a million different times. Everyone's trying to disrupt Bloomberg. Everyone says, oh, the interface doesn't look nice. But one of the things that I've also heard is that, UI, UX isn't all about how something looks, right? So people will say, oh, Bloomberg, maybe the font's not the best. But a lot of people are just used to it, and it's what people have used forever, and it's really sticky, clearly. I want to hear about that. Like, do you think that Bloomberg will, and maybe you don't want to answer this question, but do you think that companies like that, or large incumbents who have products that are clearly very, very sticky, will be dominant, even in the next 10, 20 years, with all these newer players that are starting to innovate, that move faster, and you guys at Databento with 1/100th of the manpower even, and far less money. How do you think these incumbents will adapt, and what do you think the future ecosystem for, I guess, for financial technology, for financial software is going to look like down the road?
First off, out of all the podcasts I've been on, this is probably one of the best podcasts that I've ever been on. Really kudos to you for you've probably asked some of the most unique questions to me that I'm very impressed, by the way. Fantastic. That is a fantastic question on Bloomberg. And, right, you're right. There's been 1,000 startups that have come before Databento that have said, hey, we want to do a cheaper Bloomberg, or hey, we want to disrupt Bloomberg, right? And all of them have died. And, so what is the fate of Bloomberg? And also, what is the fate of Databento? What's the fate of, or is any startup really going to, disrupt Bloomberg, right? So that is a really, really great question. I'll try to answer it from different angles and go from there. So let's see. First, from Let's see, the perspective of Databento first, and then I'll answer from a wider perspective. When we first built Databento, actually, we first talked to actually my first company, Domeyard's LPs, to try to ask like our investors in the fund, what are your problems, right? Like, what are your data problems? Like, how did you scale this big despite data being such a big problem for you guys? And they talked about, none of our summer interns get any data because like data licensing sucks. And one of them, they're building a data app they're trying to build like Robinhood competitor on their phone. And then they got a legal threat from one of the data providers being like, you can't do this because it's IP infringement, and so they were really pissed about that. And so they actually came to us and like, if you can build a data provider and not have like restrictions on usage and make it like easy to use, API friendly, and just make the next generation data provider. And one thing they told us, they said, don't build another Bloomberg, right? Like don't like do another Bloomberg competitor. Be one step upstream from Bloomberg instead. So instead build like a sandbox environment so that other companies can build whatever they want on top of you. So like NVIDIA, but for data or something. So think about it like, so companies like AI companies can build the next big AI thing on top of your data, or brokerages or fintech products can build the next big fintech app on top of your data, right? It doesn't need to be a Bloomberg. It can be some cool fintech product or some trading thing or some game or some app, right, on top of your data, essentially. So so that's kind of how we operate, is that we don't do analytics actually at Databento. We don't do AI at Databento. All we do is just provide the data behind the scenes, the data, like the lifeblood, the backbone of like the industry. And then we allow our customers to build freely on top of that data, whether that's building an app, whether that's doing AI stuff, whether that's doing trading strategies on top of that data. And so we're actually one step above Bloomberg or upstream, I guess. We do sell our data to a lot of Bloomberg competitors, like more direct Bloomberg competitors, where they're trying to build maybe an open source Bloomberg, or they're trying to build more modern, like Bloomberg in the cloud, or there's different versions of that for sure. And so that's kind of where we sit, I guess, in relation to Bloomberg, is just one step upstream. Now, in terms of where Bloomberg's going to go, I mean, definitely at this point, at least from my perspective, it's not really going much anywhere just because it's so solidified in this industry, at least at this point in time. There's still like a whole entire industry that relies on it. The chat everyone talks about, right, is so incredibly valuable. And until that chat implodes and until that network implodes, like it's still going to stay around because the value of that network is so incredibly, it's just very like valuable. So yeah, it's going to be there for a while. Bloomberg's biggest competitor is kind of crumbling, by the way, at this point in time. There was an article, like a big scathing review by the Terminalist, which came out, I think, yesterday or today, like fairly recently, which you can read about as well. They dissected LSEG, which acquired Refinitiv, which is considered Bloomberg's like big rival, essentially. And it talked about how Refinitiv is basically like not doing very well. And so I think that's even more fuel for a firm like Bloomberg to, like basically take advantage of that and continue innovating from there. So yeah, Bloomberg really has a very solid culture, by the way, too. Everyone we talk to from there, they've worked at Bloomberg for 20 years. The tenure there, right, is absolutely insane. I think that says a lot about their culture as well. So like I have only good things to say about the firm because people work there for 20 years. I think that says a lot about, like how strong the company is at this point and what a moat they've built around, around this space and stuff. So yeah, I think they're at least here to stay for a while unless some disaster strikes and something weird happens, and who knows, right? I don't know if some leadership disaster scandal happens, maybe like that could be the thing that tips the scale. I don't know. But until that happens, like, they're still going strong, at least at this point in time, is my opinion. Yeah.
Yeah. I mean, clearly they've built a very extremely dominant business.
Mm-hmm.
I guess one of the things that you mentioned that I am extremely curious about, it's the fact that, and I'm sure like, when you were speaking to your LPs, what are some of the problems? What should we build? And you arrived at the conclusion that you should build something upstream from Bloomberg. I think that's a great insight, and how you only focus on that, and that's the only thing you stick to. You don't do AI, even with all this noise around AI, when you would, I guess, be uniquely positioned to build the AI for finance because you have access to all the data. It would be easy. The fact that you stick to your bread and butter, which is data, I find that admirable. And I think that, I mean, it does put you in a position where you can really focus on winning in that field, and it's the reason why a lot of your competitors are going after you. I guess one of the things within that, and the fact, and you also mentioned that you're selling to quants, and these are intelligent people, extremely intelligent people. Uh, I'd like to hear about how you stay attached to, or how do you stay grounded in knowing what your customers want? Because obviously you're no longer operating on the buy side. And so how do you make sure that you are up to date with industry standards?
Yeah. Oh, that's such a also fantastic question. And the first time I've been asked that question. So, one of the good things, by the way, is like, thankfully, like for us at Databento, like large majority of our team we are our ICP. So we are our ideal customer profile, just in terms of natural personality, by the way, in the sense that like we're all allergic to sales. Like, we have that like natural kind of quant persona, like just kind of naturally by instinct a little bit. We're all naturally like we hang out. A lot of us just naturally hang out with groups of quants like in our free time already. So we already kind of have that just kind of ingrained in us a little bit. And so we do kind of hang out with like groups of people just naturally in our free time, just offline a little bit. So that helps definitely a lot. I was at a wedding like 2 weeks ago, like with a group of people. Yeah, so like from one of the large trading firms, and it's just all like basically the whole community was there. So stuff like that definitely helps a lot to just kind of stay in touch with kind of what's going on in the space and what people are seeing and stuff like that too. And then I'm trying to think of what else helps a lot, being on the data vendor side. Oh, also listening to our customers. We have a public roadmap at Databento. So we let our customers kind of, upvote and comment on items. And so they get to really vote and decide on like, like really comment on and see like, okay, if they want to see certain data sets, let us know, right? And so they can go on our website and upvote, like a Reddit. They can upvote on certain items, and then also when they upvote it, they'll get an automated email when we start to develop it and an automated email when we actually release it. So it's almost like a roadmap that we can communicate back and forth with each other. So yeah, it helps to like have feedback like that from customers too. That's the other thing, by the way, is like we have to also learn like when to say no to things, right? And we do get pitched a lot by like other startups trying to sell us products and random things, and knowing when to say no to opportunities, and having a very solid roadmap laid out in front of us, that helps a lot. We do have a lot of we've had this situation happen where some like maybe very sophisticated customers they'll pay us in advance and be like, hey, we'll pay you this amount, and now you can have the confidence to go out to this new exchange or somewhere, I don't know, some European exchange that we haven't gone out to before, for example, and be able to get all their data, capture all their data, and because it's expensive at the very beginning, right? So it's almost like they're investing in us and paying us in advance to go out there, because we don't want to go out there first, and then we're like, if we capture all this data, and what if no one buys, that data, then we just wasted all this money. But if someone pays us in advance, then that guarantees that, at least we have the money now, so it like guarantees that we have a day one customer. So we're starting to get that now, and that helps guarantee that, we have a day one guaranteed customer to break even on that data set. So yeah, we're starting to see that as well, which helps us at least guarantee that we get some revenue on day one. So yeah, I think those are definitely helping us a lot in terms of, one, staying grounded, and also two, guaranteeing like at least some break even in the near term on our roadmap. So yeah.
Oh, for sure. You don't want to be in the position where you go out to some exchange and you get all this data and no one wants it. So
Yeah.
outstanding. Last, final question. I want to ask about some advice for young people today, because your career path has been quite unorthodox. You're in the quant space, but you didn't do the I'm going to work for intern and then work for 3 years and then try to climb. You kind of went buy side and then data, right? And then buy side, it's been like on your own, figuring everything out by yourself, which is, very challenging. And I think a lot of people, a lot of young people now feel the need to do that, even though, even if they don't want to start a company from scratch. Because, when you look at, let's say, the pipeline of let's say you're upper, even like you're top 20% in terms of, let's call it technical IQ skills. Even then, it's still very, very challenging to find, an outstanding job at a firm that previously would have given you one 5, 10 years ago. All this disruption is happening extremely quickly. You talked about large AI companies buying some of your data. I mean, they building all these agents and models have essentially, well, it's not done, not yet, but made intelligence ever closer and closer to a commodity. It's just, like a junior guy has a lot less opportunity now and provides a lot less value now than he did 5, 10 years ago.
Yeah.
And so I want to hear it from you. How should a young person navigate this today? Because it seems like a lot of the prescriptions that worked before no longer work, and there's so much disruption happening.
Yeah, for sure. It's a great question. And, I think about that a lot too. Like, if I were to start my career today, right, how much more difficult would it be? For example, like, would I have even made it to MIT? Probably not. Right. Everything gets harder and harder over time. Absolutely. I can definitely see that. Even to give you an example, my brother just graduated from college as a CS major and he is unemployed. Right. Versus for me, I graduated from college. I was probably bottom of my class. I wasn't even a CS major. And I had so much, I was able to fundraise, and it was hard, by the way, but at least I was able to do it, right? And thinking back on like at that time, it was objectively, I would say, obviously, everything gets, this is the other thing, right? I hate it when like boomers are like, oh, the quality of students has gone down over the years or something. Like, well, everything's more competitive today, like it's harder today than ever before. You would never have made it to college, today, so stop saying that, right? It's like, it really bothers me when like older people, the older generations, like, say these kinds of things and complain and they're like, oh, just get a job, like, why don't you just buy a house and have a bunch of kids? And it's like, dude, like the markets, it's like impossible to get a job, right? And so I think it's just putting things in perspective. Like, yeah, absolutely, the markets are cooked. Like you're not gonna be able to. It's really hard to get a job. So like, I think I empathize and I do want to acknowledge that because that's real and I feel that. So like, yeah, absolutely, I do want to be able to say objectively that it is harder today than it has been in a really long time to be able to, get a job and get started in this industry, especially if you're a software engineering grad. I can see that even in my own family. And by the way, I'm not a nepotism kind of person, so I refuse to hire my own brother. That I'm just not that kind of person. So yeah. Anyway, let me say some other words. Let's see. So how do I say this? Like, trying to think of what else. Like, yeah, it's like, well, the best way to put it is looking back, it's like it was harder for me in some ways, I guess. But nowadays, like it's gotten like the technology's like it's more accessible, I guess, if that makes sense. But then it's like that it's like everyone's, I guess it's more like, how about this? The best way to put it is we would all be farmers if we didn't adapt to all the technology that was around us, right? We'd all be like farming on the field. So it's like, yeah, we all learn to adapt to AI too, right? And so like, I think humans learn to adapt to nature and to all the technology around them. So like, yeah, we'll all learn to adapt to AI and like we'll have new jobs. Like, by the way, 10 years ago, data scientist like was not a thing, by the way. I look at my, we have Greenhouse, like our applicant tracking system. And in Greenhouse, data scientist was not even a term in all the resumes I searched by like terminology, and data scientist was barely a term 10 years ago. And now it's a major in college, right? Like that's crazy to me. So like AI, similar with AI, it's like people will adapt to that term and it'll become a major in college. It'll become like a thing that everyone uses. And so maybe that's probably the best way to frame it is like, we'll all like adapt to it. And, and so you'll end up learning how to grow into that field and go from there. But then I'll still acknowledge that, yeah, like it's still a cooked environment. Like it's still harder than ever to like get a job. So I'm sorry. Oh, the other thing, sorry, I should mention, one thing I underestimated when I started my second company even is how much the macro economy affects not just my fundraising, everyone's fundraising prospects, and also everyone's like success prospects, if that makes any sense. So meaning like if Databento were to fundraise like at our current revenue, if we were to fundraise back in, if today was like 2021 economy era, oh my God, like we would be like a unicorn, we would be a unicorn probably, if that was like 2021. But no, it is 2025. And so, we are unfortunately, that's how the macro economy is. And so I would also keep that in mind. And, sometimes we're all the victim of kind of the macro environment, and that's just how things are. And same with like, I'm sure you guys feel that way with the housing, right? The housing economy. Like if only this was 2008, you'd be able to buy like a giant house and, live like a king. And now it's like, no, you can't even buy like, I don't know, a condo. Right. And so that it's just the reality of, our factors, the economy, how much like the interest rates and inflation and stuff. So that is one thing that I think has even surprised me going into the pandemic, into my second company. So yeah, it's just how it is. Will the markets crash? Like I would say like, there's a lot of my friends are like waiting for the markets to crash, but like life happens, right? Life just goes on. You can't wait for the markets to crash. Like you have to just buy the expensive house, like I bought an overpriced house, buy the overpriced house, like, go buy the bougie car, buy the bougie house. Like, right. You can't just wait for like things to crash and die, like, right. Cause that might never happen. And so I think that was my whole philosophy, is like, just go do it, and like, because it's just never going to happen if you keep waiting around. And so, yeah, I don't know. I know it sucks, but like the only advice I can just give is like, you just got to keep going. And, there's no such thing as one career path for everyone. So, even if you get like a weird career path that's not like sexy, it's not AI, it's not like CS or whatever, like that's okay. It's not what your parents want you to do or whatever. My parents still don't quite know what I do. My mom wrote a text to me the other day and she said, go Databento, and she spelled it like, I was like, but anyway, yeah, so they don't quite know what I do, but that's okay. So yeah, it's fine. But yeah, so that all being said, just, I would say like, just do whatever you want to do in your life. And like, so long as you're happy in your path, and then that's all that matters. So, one thing I realized when I wanted to quit, Domeyard, my first company, one of the signs I realized that I wanted to like, shut it down was when I didn't want to wake up in the morning anymore. Like I was like feeling signs of depression. Like I didn't want to wake up. I didn't want to like get out of bed. That was a huge sign that it was like, it's time, it's time to shut it down. Right. Regardless of performance, regardless of what the public, regardless of what people say. Right. And so I would keep that in mind too. So long as something like wakes you up in the morning, like regardless of your prospects, even if it's like 95% chance of failure, like if it wakes you up in the morning, do it. And if it doesn't, then don't do it. So yeah, that's where I would end.
100%. I think there is something you said about just picking the thing you want to run at and running as hard as you can at it. Because I mean, yeah, like you can say this, that, oh, quant's really hot, let me jump on that. But if you keep jumping to everything, you'll accomplish nothing. And so I think that's a great place to leave our conversation. Thank you so much, Christina. I really enjoyed the chat.
Thanks, Ethan.